So in this episode, we are going to look at the stock splits announced by Alphabet, Amazon, Tesla. These are all popular companies announcing big stock splits of 1:20. So before we go there and look at what these particular stocks are doing and why the management would have done this, I wanted to take a look at what Warren Buffett had mentioned in his 1983 shareholder letter about a stock split. So he actually has written a complete section on this, and what he thinks is, I'll just give you a summary here. He thinks this is not a pro shareholder action, and the reason for that is he thinks there is no addition to the intrinsic value of the business. That's the second point. The third point is, he contends the fact that he talks about market, talking about increasing the liquidity. He doesn't believe in that. He doesn't want traders because more liquid meaning more shareholders and more trading. He wants sort of an investment club, a shareholder club that goes along the ride with him. And that's the fourth point. And then he talks about how can a shareholder be better off, a current shareholder versus a future shareholder, right? So by dilution, of course, the current shareholder gets diluted because, of course, they get new shares and the market cap for the current shareholders remains same, but it doesn't add any value to the current shareholder. Also, it talks a little bit about tax on earnings. That's kind of interesting if you look at it. And then we'll switch to another shareholder letter by Prem Watsa. Prem Watsa is considered as the Warren Buffett of Canada. He modeled himself on Warren Buffett, and his company is called Fairfax Holdings. And in this letter, I think this is from 1995. This letter is written in 1996. So he actually talks about similar thing on stock split. And I think this paragraph is very interesting how he has written it. So basically he says that, you cannot increase the size of the cake by increasing the number of slices of cake, right? So that's interesting because if you cannot increase the intrinsic value of the company or the cake in this case. If you invite someone to a birthday party, you have a cake which is of defined size, and if your number of guests instead of 10 becomes 20, what you have to do is you have to cut thin slices and distribute it among 20 people instead of 10 people. And the exact stock split is very similar. So imagine in this case, in the example of the cake, it is 1:2. So initially you were planning for 1:1. So each shareholder is having one share or one slice of cake. Now 10 more guests have arrived. So you have 20 guests, let's say 20 shareholders. Now you have to split that 10 pieces. Instead of 10 pieces, you have to split the cake into 20 pieces. So that's the 1:2 split. And that's what he talks about. He also talks about liquidity. When the share price was very high for Fairfax, and in fact, they contributed the maximum float in the public market in terms of the Toronto Stock Exchange. But in terms of the turnover, they were the lowest. So this is very interesting. This is what both Warren Buffett and Prem Watsa are saying, that they are not interested in shareholders who turn around the share a lot. The other piece they also talk about is not selling the shares, right? So whether it's Warren Buffett or Prem Watsa or Tom Gaynor or Markle, you take note of all these guys. They never sell the shares. They hold on to it. And many of these companies don't issue dividends because they know how to manage the capital. So they allocate the capital from the earnings to grow the company. And that's why you see the book value and the shareholder value for someone like Berkshire Hathaway or Fairfax has grown so much in all these years. That's because they have grown the intrinsic value of the company by putting the earnings back to work, right? Whether it is acquiring companies or taking a percentage of the cash and investing like Warren Buffett has done. Warren has probably got 17 stocks, bought at a book value of 145 billion and worth maybe $345 billion, right? So do check those numbers. I'm just talking from memory. I think those are the interesting thing. Insights from two prominent investors who are not very pro stock split. Now let's look at why would a business do that, right? So I think there are two or three things. One has to look at let's look at Google, which is also known as Alphabet, and they have an institutional ownership of 66%. So probably they're thinking that they would like to bring in more retail investors because the share price is 2,290. So if I'm a retail investor, I can only buy one share of this. So that becomes a very fractional way of handling investors and becomes a pain for the investor relations, I guess. So let's look at Amazon. Similar challenge. Price of 2,165, and then again 60% institutional holding. Tesla has much more retail shareholders. They have an institutional ownership of 41%, but their retail ownership is increasing in general. So that was the first point. The second point, I think, if you look at the bid-ask spread, right? So I'm looking at the bid-ask spread for an options chain for Google, and if you see for the June, the bid-ask spread is around $12 or $13. So there's a big spread between the bid and ask. So do you think the buyer and seller will meet? They will only meet if the bid-ask spread is minimum, right? So if you typically look at some of the shares, the bid-ask spread is like runs in cents or maybe within the range of cents and dollars. So there's a huge range here. Same thing. Let's look at Amazon. It's an option chain for June, and you'll see that. That they also have not as sizable spread as Google, but they still do have like a $6 here, the $7, $6. So there's quite a spread here. So probably they want to reduce that bid-ask spread so that there's more liquidity in terms of the shares itself. So coming to the third point of liquidity, let's look at the share. Let's look at the volume in general, right? So volume is 788. That's for today. This is Amazon. And let's look at 1 month volume as it slowly comes up. So if you see the volume is around 2 million, and typically it is around that range. So you can see right here the volume changes right here. So a lot of volume here, of course, a lot of volume because the share went down. You can see it went down from 2833 to 2483. So there's a big drop of $400. So I think there's a lot of buying happening there. Same thing here. So a lot of buying maybe. So the volume increases as we see the prices are falling down. But again, the volume has been around like 2 million to 5 million, right? So if let's look at Alphabet's volume, and I wanted to do the max on this. So there's a volume of 178 just start of the day, right? It's 1123 here. Let's look at when Alphabet got IPO'd, which is Google, back in 2004. The volumes are very, very high because they were considered very niche companies. So their volume was like tremendously high. So if you can go further back, but if you look at this volume right here, even in 2014, that's like this boom, 67 million on the top of it's right here. You can see the volume. It's like 67 million on April 1st, 2014. And it has come to a point, I think, where I think the volumes have reduced. So you can see the volume is around 10 million now. and I think we are looking at a 1 month, right? So let's try to do it on a 1 day basis. So in the 1 day basis, if you look at it, the volume is around 1 million, so it's pretty low from that perspective. And it has dropped sizably. In the early days, it used to be like around 20 to 50 million shares exchanged, but the volume is very, very, very low. So those could be the reasons. The three reasons could be, as I said, liquidity, bid-ask spread, and retail ownership. They probably want to change the ownership, if you will. So let's look here, and so if you look here, the intrinsic value remains same even after the stock split. The number of outstanding shares do increase, but the price decreases in the same proportion. Typical splits are 1:2, 1:3. Nowadays, it's increased because of the share price, but the market cap remains the same, right? So whether you double the shares, if you double the shares, you have to reduce the price by half. So if you triple the number of shares, you have to cut the price by 1/3 on the day when the stock is split in the market. It helps in bringing more investors because the price goes from a high price of a share to a low price. So in case of Google, currently, let's say it's around 2,400. After 1:2 split or 20 split, it would be $120. So hopefully more investors can get in and buy. So that could be one thesis. But the cons that Warren and Prem suggested in the letter that we saw is there will be a shift from long-term investors to short-term traders, because now it gives an opportunity for short-term traders to play on options as well, because the option price on a $2,400 underlying stock versus a $120 stock, the option price is going to change. So the option price is going to be much lower, which means a lot of short-term traders are going to hedge their bets both on the call and put side. The other piece is the bid-ask spread. As we saw, it's very high for many of these stocks that we talked about: Alphabet, Amazon, and Tesla. But the bid-ask spread will reduce because more short-term traders will come, more options will be traded against the underlying. That means the bid-ask spread will squeeze, which means it will increase the liquidity. So the liquidity of the shares, one is with the dilution of the shares itself, the more shares available in the market to trade, that's one. But because of this reduction in bid-ask spread and increased number of investors coming in, or traders, should I say, will increase the liquidity from low to high. So I think some of these points to be kept in mind when stock split. There is no there is no reasoning behind buying before the split or after the split. But if you go and read some of the papers, essentially people talk about, the analysts talk about, there's a positive momentum when stocks are split, because the owner managers who run these companies believe there is more potential of growth. That's why they're diluting the number of shares and they're splitting the shares. So that's a quick gist on stock splits. And if you have any questions or comments, please comment, and please do share this video with your friends and family. Thank you so much. Take care. Have a nice day.